Hi, everyone. So, welcome to the webinar. I know I'm doing quite a few of these at the moment, but the reason for that is the reason we're doing so many of these. Let's turn the lights on a bit so you can see me better. Okay, it says optimistically with these things. Technology being rubbish what it is. There we go. Isn't that better? And crisp and clear. Welcome one and all. Let me know that you can see and hear me. Sorry, I was a couple of minutes late onto this. The reason is I just wanted to get some of the latest slides up and ready for you all. Let's share the screen. We've got a lot to do. Hi, Peter. Lovely Auckland. You are so good to be on these all the time. So thank you for that. I appreciate it. Right, are you ready? It is the 6th of January in this case, and some of you will end up watching this on the 7th of January as well. So once again, thank you all for being on. Good evening. Everyone's sound is good. We can get on with it. This is not individual stock advice. This is not financial advice. It is education information only. Don't forget to look at campaignforamillion.com. Basically, I want to, through education, through all the knowledge that I've had in all my books, my Financial Times columns, everything else, is to impart this so people become multimillionaires over their lifetimes through their investing. If their investing grows and doubles their money every 3 to 5 years, then you do the maths. Doubles every 3 to 5 years, 3 to 5 years, 3 to 5 years. That's the goal. Very simple goal, very focused goal. Where are we in January at the moment as things have started? And we're also going to look at some of the news. Let's just start off with some of that news first and foremost. And what you can see, S&P 500, fresh record. Dow adds nearly another 500 points. Okay, for first close above 49,000. It is just absolutely insane out there. And now it's getting a bit euphoric as the FOMO kicks in with people as well. That's exactly where we are on the markets. And you can see why I keep talking about doubling money over 3 to 5 years, because that's what's been happening over the last few years. And we'll also look at what does that mean going forward. Now, looking at the news, I like going through CNBC and Bloomberg to see if there's anything catching my eye which would cause me any concern. Venezuela doesn't, Greenland doesn't, NATO doesn't, Ukraine doesn't. None of those things impact the kind of stocks that we're holding for the longer term, not least because the people who work for me, whose job it is to earn me money, whose job it is to work out whether it's AI, quantum computing, oil, which countries they should be making profits from. Those people are called Satya Nadella. They're called the board of Apple. They're called the board of JP Morgan. They're called the board of Goldman Sachs. They're the people who work for me, and their job is to make me profits. They have one task: to make me profits, make the shares in their companies that I own to go up. So I don't worry about the things I've hired them to worry about. And how have I hired them? By becoming a shareholder in their companies. So that's why you can see Venezuela is noise. Oil is noise at the moment. Okay. We will go through one or two of these issues here, but there is, again, nothing particularly concerning me. Now, I do happen to own, I can't believe that's gone up 27% yesterday, because SanDisk, Western Digital, if you watched what I said yesterday, and Seagate, there were 3 that I'd already mentioned to you. Yesterday's webinar that I owned, I drew the circles and said, well, I didn't know they were going to do so well. Bloody hell, today, given the amounts that they've already gone up. That doesn't mean you then say, oh, he's got those, so we should have those. Okay? That was just yesterday's webinar. You're not chasing day trading one day. Oh, he said that momentum. It has to be part of a portfolio in a professional approach. So we'll go into that and what it is that helps you construct a portfolio. Okay, so those are the main issues at the moment. Let's turn back into some of those issues. I want to turn back into some of those issues. How is that translated for what's going on at the moment? Let's look at the UK and let's look at the US. Now, with the UK, what's happening at the moment is some of the, I mean, it's all world economy anyway, some of the insurers, energy, banks. It's basically attracting more of the cautious capital, the kind of people who are worried about this kind of, oh my God, Silicon Valley chips are going up. Silicon chip companies out of Silicon Valley are going up 17%. No, that's not for you, madam. Why don't you put your money in an energy company, insurers, or a bank? So it's a very British way of investing, and it's not doing too badly. Okay, overseas buyers are also drawn into valuation and not the kind of high growth stuff. You don't come to Britain for high growth. All right, and if that comes as a surprise to anybody, sorry to ruin your dreams. And there is a room for that, and those are not doing too badly. And that's where we're sitting at the moment at the start of this year, and that's the way January is going to go. If we turn to the US for a second, yes, there are some concerns about a stretched valuation. It's the mega cap companies which are doing the heavy lifting. They're the ones which are showing the most profits, going up the most. We know that. Now, this is what's going to be critical, and I'm going to tell you what I expect to happen going forward, or rather, more importantly, I'm going to tell you what I'm going to do regardless what happens. I don't know what's going to happen. What I know is what could happen, and it needs circumstance, what my strategy is. That's the way an investor thinks, a professional investor thinks. A gambler, retail client thinks, I'm going to guess which route, path A, path B, or path C. A professional thinks whether it's path A, B, or C that comes my way and is out of my control, I have a strategy for each one. Okay? That's the difference, and that's what I'm going to show you. Now, what's going to happen now is we're going to go and focus more on profitability in January and February because earnings season's coming about. So that whole talk about, hey, AI and interest rates, that's going to die down a little bit, and what's going to be notched up is more talk instead about where's the earnings, where's the profits. And these companies continue delivering them, and they will continue to deliver them. Anybody that stumbles, like an Oracle or an Adobe, they will drop 20%. Doesn't mean that they're out of the race. It doesn't mean that they're fossilized. It just means get ready for that volatility. And I'll go into more detail on all of this. Gold, so far, seems to have replaced crypto as a safe haven. Crypto, it's stuttering around $100,000. If you hold it 5% max in your portfolio and you hold it for a long period of time, that's how you mitigate risk with crypto. For any of you who want to hold it for a shorter period of time and hold more of it, you're a gambler. The shorter the time frame you hold it, the more money you have in it, the more you're a gambler. It's a very simple equation. It's a very simple algorithm. Okay? If you have 5%, you're holding it for 10, 15 years, you're not a gambler. You're an investor, right? That's how it works with crypto. Similarly with gold. 5% max is what I'd have in my portfolio. Physical gold coins. No, I don't have silver for a very simple reason. Gold is tax-free, capital gains tax-free. So I have the coins, or rather my wife has the coins from over a year ago. Wish we bought more, wish we continued buying them. We didn't do either of those because once you max out at the level you're comfortable with, and the max should be 5% of your investable assets. Now, if you want to try and do gold for a shorter period of time and more money in it, you're gambling. Good luck to you. This isn't the webinar for gamblers. That's on the Gamblers Anonymous channel somewhere else. The focus is shifting from interest rates to profitability. I'll keep an eye on those things for you. So don't worry about those elements at all in any event, but just to say, we will keep an eye on those things for you. The next thing I want to turn to, just go back to that news element, because in the first 15 minutes of the webinar, I do want to cover, the news elements, okay? I want to cover news elements. I also just got it with the market closing. I just want to keep an eye on the markets, okay? All right. So that's that. I want to show you something else. If we look at these, okay, these issues over here, in terms of the Greenland stories and all this, the market really couldn't care less. In fact, Venezuela is making the market very excited, because if the Americans are out to just do a land grab, not like the Americans, go ask the native Indians what the American spirit is. If they're going to do a land grab and take all that wealth, then guess what you've got? You've got a scenario where the Americans are about to get a lot richer without really having to do anything. Not bad, eh? Okay. Nickel, I'm not really into single commodities, whether it's copper or otherwise. If you wanted a commodity exchange traded fund, we can look at those in a second, but I'm not doing, oh, there's a headline, let's go into it. Copper's also a new all-time high, so is gold. So I guess metals-based exchange traded funds, we can have a look, might be okay. But we're far more steady in our approach and professional rather than gambling. Now, if you want to gamble, you can set some cash aside for it, and that's fine, but it's not what we do, okay? 3.7% in first full year. It's a great business if you can get into it. You get paid a shitload of money for being rubbish. Okay, I'll let you into a secret. The more capital you've got, the harder it is to get a return. Yet, the more capital people have got, the more they're given. So 3.7%, he's laughing. Nice one, Mr. Jane. You've just made yourself a billionaire and everyone else a little bit poorer. There's the industry right there. It gets worse. Okay. Somebody today had said to me, yeah, that Nick Train's all right, isn't he? I heard he's pretty good. Okay. And so I looked it up. I thought, Nick Train name rings a bell. Okay. And let me just pull up what the hell happens with an idiot like him. Okay, and I can't find the article now, but there was one where he just paid himself 16 million, okay, and had managed to lose a shed load of money in the process. Oh, here we go. There's one. That's your retail fund manager. Train, I'm running out of ways to say sorry. I'll buy you a freaking thesaurus because you're paying yourself a few million. That's from January, okay? So we did some maths on what his returns have been, and it's minus 25% in the last few years, last 3 or 4 years. In the biggest bull market in history, he's managed to lose 25%. It looks like the Americans are going to go into Greenland and take it over from the Danes. So that does look like the next thing. Okay, where are we on the S&P? S&P 500, that's where we are. Now, 3-year winning streaks are not that rare because you can see them there going all the way back to 1994. You can see them over there. They're not actually that rare. You can see down years. They're rare. Down years are pretty rare. Okay. You can see it right there. Okay. So let's have a look at, we're going to have a proper look at some of that stuff in a second. This is the year-end forecast. All of Wall Street is optimistic. What does it mean? Yeah, Terry Smith's another one. That 5% returns over the last few years. Absolutely atrocious. And we know they're really bad because if you look at campaignforamillion.com, where you go into, if you go into, there you go, Terry Smith and his fund. But the newspapers will build them up. The newspapers will big them up and the newspapers will defraud you. Okay, we looked at his numbers and returns and how 5.8% per annum what it would generate you compared to just buying a world ETF or a FTSE All Share even. You just end up with a hell of a lot of money, more money than doing it his way. And he continues to be rubbish and will continue to be rubbish for a long period of time because he's too busy in Mauritius, wherever his second home is. And you guys are paying for it. Okay, masterclass media. And we did the maths on it. So I'm not going to go into, Nick Train's another one. They all end up the same. And the reason they do is because with so much capital, there's very few companies they can buy and they create funds in the case of Vanguard and whoever else as well. They create funds which are just picking from a very small group like China, because they know they can sell that to you because you will see that on the tin and you'll think, oh my God, I've got a China fund. No, you haven't. You've got a fund which is only picking from a few companies. Well, that's like me picking a World Cup winning squad from Watford, right? They know how to pull the wool over retail clients and how to market and sell. It's a sales thing. And we know their performance is rubbish because Eugene Fama got a Nobel Prize in economics for proving how rubbish they are. Anyway, enough of that because I keep banging on about them and kicking them in the teeth. They're so easy to kick in the teeth. But quite frankly, I'm getting to the point where I'm just going to call them bloody fraudsters because they know the Nobel Prize winning economic literature shows they cannot outperform the markets. Warren Buffett proved that they can't do it. The reason somebody like Warren Buffett can do it and you potentially can do it is because you have a choice of as many stocks as you want. Okay. And even putting Buffett to one side, you have a choice that you can then filter those down to the highest quality. They can't do that because they have to pick whatever their remit is. If it's Europe, only European companies, and then only the biggest ones because they've got so much capital. I'm assuming none of you here are trillionaires who have a capital allocation problem. The biggest problem for 2026 is going to be the turbulence, how much the market could fall. Okay, and I'm going to show you this specifically. Actually, I'm going to show you that now. Okay, I'm going to show you that now as well. Okay, so let's have a look. Here we go. I'm going to show you the S&P first. All right, S&P 500. There's the index on the S&P 500. And the biggest problem you're going to have is that drawdown in between. That's going to cause the panic. And we're going to look at that in terms of a portfolio and how to dampen that in a second. Because look, yes, I could say to you, this thing goes up. So how come everybody didn't just buy it and sit back? Because obviously, either you want more than that, so you want individual companies which are causing that to rise, like NVIDIA, okay, or you panicked or you got bored. It's simple as that. Okay, and or all of those. That's NVIDIA there, but we'll come back to some of the stocks in just a second. That might not look like a lot, but when that happens to the S&P, that causes a lot of people to panic very, very quickly. Okay, and it's that panic which kills them. It's that panic, okay, that kills them. All right. I've just got Paresh saying, should we test the mic? I'm a bit half an hour late. The 14% sounds like not a lot until you get punched in the face by it. So you're going to have to keep calm this year. Let me tell you where we are on the markets as a whole, okay? Where we are on the markets as a whole is, if you look on there, still at 0.1, read what it says about 0.1. Okay, what does that say? It says, you better be cautious, but it's going up. That's what it says. Okay? That's literally what it says. That's where we are. So let me show you where we are. There you go. That's why we're there. So don't panic. That's where we are. There's not, I mean, I'm getting bored telling people this. That's where we are. Alpesh, does it mean it's going to go down? I don't know. But if it does where it is now, and continues going up, I make money, so I'm happy. If it dips slightly, I don't mind because I know it's a slight dip and that's fine. And I might even buy the kind of companies I own, a bit more of them. If it dips and let's say Goldman Sachs and JP Morgan fall, I'll buy more of them. Or Western Digital falls, I'll buy more of it. Okay? Equally, when you see this happening, and it's a longer fall, depending on the individual stocks, we'll make a decision when we come to it. We're not going to make it now, okay? We're not going to make that decision now. We don't need to make that decision now. That's the point. And that's often a point that people miss, is they're too busy trying to make decisions well before they ever need to. And the reason is, I understand they think there's going to be a fall in the future, so they think their job's to try and pick the tops and bottoms of markets. It's not. The markets can only do one of these three things, okay? And that's how periodically they happen. And the best and most important thing you can do is to stay calm. Now, I happen to have 2 times leverage exchange trade fund on the S&P 500. We happen to have it on the FTSE. But that doesn't mean we're going to panic. When there's a slight fall, we might, on the leverage, I'll show you those in a second, take some money off the table. Okay, it's as simple as that. We'll just take some money off the table. And we don't know whether it's going to be this, or this year. And we don't know whether it's going to be this or this. But it's more likely to be this, because that happens more frequently, than this, which happens more rarely. Okay, so take a picture of this if you wish. The optimal route is only known in hindsight. Your goal is not to be perfect, but to be prepared and stay in the game. Be ready for the bouncy ride as opposed to see the bouncy ride and absolutely panic. That's what knocks people off. And it knocks them off because they never had companies that they should have owned in the first place. That is why we start off with 10,000 companies to go with. Okay? And when we go through these, okay, when we go through these, the reason we reject all of these because they don't hit our value, growth, income, our cash return, capital, our momentum, or our CETINO. The reason we go through all of these is so that what we're left with out of 10,000 companies in all these sectors, none of these meet our requirements. What we're left with are ones which we are so confident with, we like so much that should they fall, we're fine with it. And we would buy more of them. Do you see? Do you understand? Does that make sense? It should absolutely make sense as a result. Okay? It should absolutely, as a result, make sense for that reason. Now, wait a minute, Alpesh. What you just said to me is, if you start with 10,000 companies and you have such high requirements that you're only going to be happy with 200 out of those and narrow those down to 20 to 40 holdings, okay, you've got London Stock Exchange, New York Stock Exchange, British, BATS, European, NASDAQ, then of course, what you're looking for is not what we're looking for. What you're looking for are the kind of companies you want to own even more of. But why do you start with 10,000, Alpesh? Because my criteria is so high. Well, why do you narrow it down to 20 to 40? Because if you hold more than 40, you've got a bureaucratic mess and you've got so little money in each one that what's the bloody point? Why not less than 20? 15 to 20, less than that, and you've got single stock risk. Really simple. Very simple. Okay? Investing's a lot simpler than Nick Train would like you to believe, because Nick Train wants to take your money and self-evidently has proven not give you a positive return, but a negative one, and make you think he's some kind of genius. The guy, look, I need a new cleaner. If you find him, please tell him. He can come and clean for me. But he won't, because he's just received £16 million of your money. In the city, that's legal. I don't know why people go into a life of crime when they can just go in the city instead and become a retail fund manager. For God's sake, my secretary, who used to open my letters, after 2 years of doing that, went to an asset management company and has become a fund manager. Listen, I'm telling you, I don't know what any of you do, but if you're a secretary, if you're a cleaner, go into asset management. They'll hire you at Newton Fund Management. Okay? Don't need any skills. But you want to be a bit better than them because they just want people who will take the money off retail clients. Well, I don't want to do that. I don't want to take your money. I want you to keep hold of it. And I want you to learn what's going on in the city and how it's ripping you off. Okay? Don't make these mistakes either. Right? Don't make these mistakes. They're on screen. I don't need to repeat myself. It's the reason I put it on screen. Okay? Okay, it's over there. Now, whoops. These are valuations. You're paying $25 if you buy $1 of Microsoft profits. So think of it like a house. Microsoft, you're paying $25 to buy the house, which gives you $1 in rent. So the price earnings multiple, in other words, for every future dollar of profit Microsoft is expected to make, if you buy a share of Microsoft, it costs you $25 for every future dollar of profit. Walmart costs you $37. Costco calls you even more. Now, there are times I've held these, whether in a model portfolio or elsewhere. But look at how close these are in valuation to each other. I'm not saying Palantir is rubbish, but that's probably trading more on momentum and growth expectations. Valuation is not the only thing that moves stock prices, is what is my point. In the last 12 months, Google went up 60%, Microsoft 11%. The valuations are now pretty much identical. Valuation is not the only thing that moves stock prices. Valuations, if you bought a house and you thought its price is going to go up more, then you would pay more for it. That's called growth. Growth is an important factor which people don't realize. And hell, yes, I own Micron, bought some more this year already. It was part of a model, bought some more. I hope my clients in the Great Investments Program will kill me for revealing little snippets. The point is, individual stocks, you'd be an absolute fool to say, Alpesh has bought it, so I'll buy it, because I think portfolio level. So if Micron moves up or down, I don't panic. You will. And I'll give you a classic example. Microsoft, 2021. I had Microsoft. People heard it. Some bought it. At the end of the year, I was up 51%. They weren't. Why weren't they? Because they panicked during the course of the year when it fell, because for 9 out of 12 months, it was falling or going nowhere. Or they got bored, because for 9 out of 12 months, it was going nowhere. Well, I didn't. So the foolish people look at individual stocks, and they'll see a stock drop 20%, and they'll say, oh, no, Alpesh, you still own it? I tell you what, if you want to do that, just wire your entire pensions across to me and transfer the rights to your will, your estate, and your home, because you're clearly willing to delegate your most precious assets that you've worked your entire life to somebody else. No, you should be looking at it and saying, right, wait a minute, that's Micron, but how does it look inside a portfolio? And we're going to go into that in a second. It fits inside it because it's dampening other volatilities. It's not accentuating others, and I know not to panic or get bought, for instance. Okay, similarly, I don't want Tesla, not because of the valuation, but because of the volatility. So a portfolio should be constructed like a bespoke suit, suitable to you. Otherwise, you will get panicked and bored and you'll F it up. Okay, you will absolutely mess it up. There are times when I've wanted and have owned and own Lam Research, but it's expensive. Okay, so valuation are not the only thing, is the lesson there. Where's the Nasdaq? My God. This is what you might call a tailwind, which makes Alpesh look clever. Anybody who's got any sense knows Alpesh isn't actually clever. He's just riding a tailwind. He's just riding on the coattails of companies that make profits and the clever people who run them, and a broader market, which is a tailwind. I'm claiming credit for it. I'm not claiming credit for it. I keep telling people I don't do it. They do it. And then I stay out of its way. Okay? Lyndon, I don't look at sectors. Look at the stupidity of our pharmaceutical companies. Good. Which ones? Any specifics? You know, companies on planet Earth are good. Which ones? Okay. You're buying a company. You're not buying a sector. And if you're buying a company, then you need to know what makes a company price move. And yes, there is a slight correlation between the sector and the individual company. But you know what's far more correlated to stock price movement? And we know this from Nobel Prize winning economists. You know what more relevant? This might come as a bit of a surprise. Their accounts, their profit and loss, their balance sheet, and their cash flow statements. They matter a lot more than the label of the sector they're meant to be in. And I'm going to show you why. So you've learned this from the 1980s possibly, and some magazine and some dimwit journalist who had a word count, but whose day job is to type on a keyboard. And you've thought to yourself, yeah, they wrote that on Shares magazine. Get pharmaceuticals looking really good. They've got a word count. And guess what? The pharmacy writer only knows about bloody pharmaceutical stocks. To a man with a hammer, everything looks like a freaking nail. So ask the pharmacy expert at any brokerage or any fund, hey, what do you reckon about pharmacy stocks? And they'll go, bloody amazing, mate. Okay? Instead, we look bottom up at the individual companies. Why do we look at that? Because the data is at the company level. We know that it's the company's balance sheet, cash flow statements, and P&L accounts that move the stock prices, not the fact that it's in a good sector. There is a slight correlation. The correlation isn't as strong as you think it is. How do we know that? Because we look at the bloody data. We don't just say, well, no, let's look at that journalist. Flippin' heck, if you think I'm giving my life savings to a journalist to manage for me, these are the mistakes private investors make. It's not your fault. Nobody ever told you any different because they all had a conflict of interest. FTSE 100, this is where we are. Now, this is a measure of, think of it as a measure of short and medium term average prices. This is going up. It's really simple. then you're okay to hold. Would you buy more? Well, if it's at the top part of the graph, it's a bit overbought. Historically, as I've said time and again, when that's happened, historically, when that has happened, okay, over there, the price has tended to fall lower. Okay, the price has tended to fall lower, except this time. And that's because there isn't a guarantee. Nothing in the market's guaranteed. There isn't guarantee, and it's going up, okay, at this time. And as long as it's going up, you're going to get three decisions: buy, hold, or sell. Well, we haven't got a sell signal, which would be it's falling, so we'd hold. Would we buy more? Cautiously, it's overbought, but cautiously, not a problem. Now, those people who are my clients know that every single week I show, amongst other things, the 2 times leverage FTSE 100 and the FTSE index. And yes, it's done well. They will also know I didn't expect it to do well. Okay, so I can own something and be surprised at how well it's done. NVIDIA is another example. In 2023, those who watched me, I said, well, looking overall, it looks like it might fall, but I don't have a reason to sell yet because the price keeps going up, so I'm going to hold on to it and hold on to it. And I'm looking at it and bloody hell. I felt a lot like, I'm sure, Bitcoin owners 10 years ago, or gold owners. It was like, flipping heck. Because think about it, if I knew it was going to go up that much, I would have put everything in there and nothing else. Okay, that's the S&P 500. I own the leverage on it, but I don't recommend you do leverage. And I'll tell you a very simple reason why you don't do leverage. Look at how quickly you can lose half your money. But our rules are very simple for leverage. It's for very few people. And if this is rising, we're in. If it starts falling, we reduce positions. If it crosses below its own moving average there, we're totally out. It's very simple. Okay, Tesla's down 4%. You see the volatility I don't like. NVIDIA, where are we on that? Now, I'll tell you the period when I was really shocked by NVIDIA. It was this. Anybody who goes back to my YouTube videos and looks back at 2023, you will know. Okay, I kept saying at that point, well, looks like it's toppy and it's overbought because it's right near the peaks of its historic highs before. Looks like it might fall, but I don't have a reason to sell. And I didn't, and it just kept rising. Came as a surprise. The other one I want to show you, which will also, okay, Nebius Group, I don't have any thoughts on it because I've never looked at it. Now, the other one I want to show you is what happened in 2022, when I'll give you the classic example of Meta and why we said famously go into cash. And it worked a treat. So it might not have done, but it did. And it was simply this: January 2023, it was the prices moved, the moving average moved, short and medium term moving averages started moving lower. So we said, right, I think we need to get out and hold cash for a month because we didn't know what the future would look like. Could have been a V-shaped recovery. Then a month went by and said, oh, okay, still not looking good. Average prices still falling, still falling, still falling, still falling. And then once they started rising around January of 2023, we said, okay, it's safe to get back in. Now, that worked really well with Meta because it meant we saved ourselves, what is that? About a 53% drop. We didn't save ourselves we can't see tops and bottoms. We don't have time machines and crystal balls. About 56% drop, kept the powder dry. Unlike fund managers who can't go into cash and got you over 2 years, 0% return. Okay? And they say, oh, you holding on. Well, no, we kept our powder dry. So when we did get back in, it was 1% to their 0%. Right? Very simple, but it worked well. It just worked well on looking at the average prices. Why average prices? Why not the narrative? Well, narratives are full of cognitive biases. Nobel Prize winner Daniel Kahneman, Nobel Prize winner Richard Thaler, their research on that. I've lectured on it as a fellow at Oxford University on this. And yeah, it is a flex, but I thought I'd better make it bloody clear that I'm not just read a book. Okay. And when I was lecturing on their work, it was before they got the Nobel Prize in economics on this stuff. And there gets to a point where I repeat myself so often, I just get annoyed. That people don't get it. It's really simple. That what's going on is that narratives are easy to misinterpret. Prices are not. You and I might disagree with the political situation in Ukraine, Russia, Palestine, Israel. There is one thing you and I will agree on, regardless of what religion we are, regardless of what skin color we are, which is 2 is 2 and 3 is 3. Numbers, prices, mathematics, We're going to agree. Okay? It's the beauty of mathematics. And you and I will agree that that is a lower number than that. So we look at prices, because the only people that matter in the stock market are people with money, because they're the only people who can afford to move the prices of a stock. It's really simple. The little old lady in Newcastle, her opinion doesn't matter. Neither does a journalist's. Okay, it's the people who are buying and selling, and that's the prices, and the reflection of the price is what matters to us when we're looking at that, and that's why we got out. You might as well, you got lucky. Fine. Similarly with this, at the moment we're holding. Would I buy more? Cautiously, but I've got enough, I think. And it might be in hindsight, I should have bought a ton more. Would I sell? No, because it's not crossing over. No reason to. I'm calm. The thing with this is, when it falls, should you buy more or should you exit? Well, there is some case to be said. If it falls, you should buy more, but you really want the fall to be quite significant before you buy more. Don't buy more just because it's fallen 1%. Otherwise, you're going to end up owning NVIDIA or nothing else. Equally, don't even buy more if it's dropped 25%, because it's the kind of company which it needs to drop a lot more before you buy more. When we put NVIDIA, Meta, Microsoft, Apple, Amazon, Alphabet, JP Morgan, Goldman Sachs, a few others into a portfolio suitable for me, not necessarily you, for me, what we're looking for is, okay, that portfolio's numbers today, those companies' numbers today on this look great. Value, growth, income, cash flow, greens across the board. They tick all our boxes. They look great, okay? So we look at that and we say, yeah, this looks freaking great. But we also do one other check. How's it done historically? You know, how's it test driven, this car? So we look back and we think, oh, okay, historically, doesn't tell us anything other than, well, historically, it's done pretty bloody good. Then we say to ourselves, what if it did half as well as that? Okay, we'll make 15% per annum. That means we double our money in 5 years. Yeah, I know exactly what returns double your money. 15% is 5 years. Okay, and we think, well, 33.4%, is about 2.25 years. Okay, that'd be lucky. No guarantee it's going to happen again at all. So we halve it. What we're really concerned about is this. Can we stomach it? Now, if you owned a house, and I said to you, over the last 6 years, the price of it at some one point fell 13.2%. You said, what do I care? I still own it. I like it. I'm getting use out of it. But with portfolios, people panic and basically spoil themselves. So drawdown's the more important number. Now, I'll tell you why. For a portfolio like that, with some of those stocks that I mentioned, and there's about 20 others, the thing which is going to kill you and stop you making money is panic and boredom. What's panic? Panic is drawdowns. The value of your portfolio goes down 13%, which means individual stocks will have dropped as much as 50, 60%, and you're going to panic. And you're going to try and trade and time it. Boredom is underwater. It's that bit, okay? 11 months, you haven't seen a positive return. You get bored, you exit. So those two things. And yet, that is a 33.4% return portfolio. People can't do it. Retail clients can't do it. They can't sit still. They're like a 7-year-old in a sweet shop. I've got a 7-year-old. They cannot sit still, guaranteed. That's why spread betting firms make a bucket load of money from you guys. Because they know you're going to panic or you're going to get bored, guaranteed. Okay? So, those are the numbers. That's what you need to know about the numbers. It's very simple. Historically, the S&P 500 average drawdown, 14%, 70% chance of a positive year based on 23 similar years since 1928. 11.8% is the median gain when the market has risen this much in the past, and 8% is the average return after a greater than 15% return in the markets. That's where we are on it, okay? That's where we are on it. And we've got strong fundamentals, double-digit corporate earnings growth, strong economy, strong corporate earnings. So what's going to mess it up for people? Panic and not having quality companies. That's what they're going to mess up. And if you look at how much the market's gone up over the last few years, the reason people didn't get those gains is they didn't have quality companies or they panicked and they got bored. Okay? Those are the predictions and the forecasts from the biggest firms. They're all saying higher. I'm happy with that. I can handle it. Take a picture of this. This is your playbook for 2026. It's everything in one diagram, okay? So that you don't mess it up. Because in there, you will see exactly what the hell's going on and what's going to cause you problems. Everything's in there in one beautiful, gorgeous, simple image. Take a picture. I'll tell you one other mistake not to make, and we're going to go back to the economy. So that's Microsoft. That's the average forecast of the analysts. That's where it is now. If the analysts are right, you're going to make a 30% return. Do not be fooled, therefore, into thinking, oh, I'll just copy the analyst. The analysts always say that about everything. Okay? Oh, thanks, Paresh. You're on. Sorry, mate. I should have told you it's at 9. I sent you the links. I sent Paresh the links. And I forgot to tell him it's 9 because it's always been 9:30. So it's entirely my fault. And he's come on. I think those presenter links should have got you on as a presenter, but don't worry, you're on that. So Paresh is there. Do speak to him, guys. He'll give you a free educational pension review on everything I've said. He'll do a one-to-one with you as well. Okay, I'll answer the Q&A. Adrian, I've got Adrian, I've got Paul, I've got KP. I'll answer your questions in a second, but Paresh is answering in between, which is even better. Okay, which is even better in just a second. Now, what I want to show you is this. When I look at today's markets, it is unusual for the UK to outperform the US, but I'm fine with that. So what? Okay, let's put in the emerging markets. They've done incredibly well over the past year. Let's look at 5 years. Okay, 5 years, Nasdaq's up 100%. The UK is unusual to have done that well over the last 5 years. Emerging markets, not so good. So they've just had one good year. The longer term, of course, what happens? The UK ends up longer term. You'd expect it to be in line with global, UK economic growth. It's down there. The S&P is up there, and that's a typical sort of picture I would expect. You might say, well, wait a minute, Alpesh, what about China? Okay, let's throw in China over the last 10 years. Hardly gets you anywhere. I'll remove emerging markets for a second. And you can see China's down there. Okay, so not as good as people thought. What about the Indians, Alpesh? I hear they're lovely, nice, attractive people. Normally they say it themselves of themselves. Okay, let's look at the Indians. Not bad. They've done not too bad over the last, over the last 3 years, no? Who's winning the race? Nasdaq. What kind of companies are in Nasdaq? The kind of companies which are in the Nasdaq are the kind of companies that the Dutch and British empires had, namely East India Company, Dutch East India Company, British East India Company, the kind of companies which can bankrupt everybody else, are monopolies, and will eliminate their competition. That's what's in the Nasdaq. How are you going to compete with that? Even the Indians couldn't. They eventually got rid of the British. Okay, you're not getting rid of Meta, Microsoft, Apple, Amazon, Alphabet, Nvidia anytime soon. You might think you are. You might think you've got an independence movement coming out of China, which is going to replace Nvidia because they're going to come up with some cheap Temu chip. It's not. And it's not just this president, the next one and the one after that. The bar's been set. They're going to make sure the imperial presidency is here to stay for quite a while, I think. Okay, so, and they're going to back their companies. They've made it very clear. The next one's not going to play fair and say, oh, it's okay, we'll share our wealth with everybody. Let's be kumbaya. I don't see them doing that, which is great because they're the mafia and I've got shares in the mafia. Meta, Microsoft, Apple, Amazon, Donald Trump. Now, that's not because I'm biased towards the US. It just so happens when you look at 10,000 companies, those guys are playing with machine guns and everybody else is having a knife fight. The other companies can't really defend themselves. There might be some good companies elsewhere, but yeah, can't really find them. Market news. There isn't something which is making me worried. Okay. Brazil doesn't do too well. They'll be the next one to lose their head of state. Okay. And I want to show some market dashboards for a second. Okay, world equity indices I sort of have done already. What the hell's going on over there? What's going on over 10 years? NASDAQ. CCMP might sound like the Communist Party of China, but it's not. It's NASDAQ. What I wanted to show you was not the companies. I want to show you the economic analysis. World economics. Here we go. Quarter-on-quarter growth. 4.3% United States. India, the fourth largest economy in the world at 2%. So the big economies like India, China, United States are growing. The Japanese decline in growth, well, they've not been contributing to the world since about 1990. So that's not really important, sadly. Wish they did more, but they can't. Britain's too small, 0.1%. Thanks, you're not lifting your weight. Europe, sorry, you're not lifting your weight. Australia, you're irrelevant. France, you're fifth largest in the world, you're irrelevant. China's important. 1% in China is important. It moves the needle. 2% in India doesn't really, but at least it's not negative. It's really America and China which are pushing the world higher in terms of growth. Okay, and that's where things are. At the moment, gold and copper, they're in a mad race, aren't they? To see who's going to do the best. That's where we are. Anyway, I could go on endlessly on and on about commodities and stuff. Let's not do that. Let's avoid these problems that are listed over there. Thanks, Presh. But now let's go to the S&P 500 over the past year. Look, I didn't know in my portfolio that Alphabet's going to go up 60%. I'd love to take credit for it and say, hey, let's do a marketing campaign around my Alphabet pick. That's why we have more than one stock. Nvidia, 34. I would have thought Nvidia was going to do more than Alphabet. As you know, I've got Goldman Sachs, I've got JP Morgan. Why haven't I got Morgan Stanley? No particular reason. I just don't want to have too many banks. Okay. Were Visa and MasterCard poor performers? And I guess American Express, yeah, not really great, are they? But there we are. What about going forward this? What about that? What about that? Well, I want you to think portfolio level. In my portfolio, there will always be some companies. I don't think I've ever had a year where every company has gone up. Maybe it's happened once in 20 years where every company's gone up. But the returns have been bloody phenomenal because we didn't do anything. I mean, I'd love to tell you we were actively trading it, but we weren't actively trading it. I mean, maybe adding to winners cautiously at times. So 2025 results, Paresh, you just calculated them, what they were last year. I've not had the team put the website changes, but you can tell people what number you found anyway. So 2024, the year before, was 41% doing value growth income. 2023 was ridiculously high. I'm too embarrassed to say it. It was just ridiculously high. 2022 was cash. It was 0 because the whole year ended up being, well, I swear, another month. And then that was the year Liz Truss was prime minister as well, by the way. So you can pretty much write off the whole year. That was 2020 to 2021 when we launched the program as a whole. So worst case is 0. I guess I'd call that lucky, though, because it could have been negative because the market was negative. Okay, let me go into the other slides and then do the Q&A. So here are some of the client model portfolios. Here's some of the stuff we've got. People ask, oh, but can you outperform the S&P 500? Yes, because every single bloody week I do a webinar with my clients where I show them the 2 times leverage S&P 500. And we did it last year. And there it is. And as you can see, it outperforms the S&P 500 with the exception of 2022 and 2018. And even if accounting for those 2 years, you still have outperformed it overall because the up years were far bigger and more frequent than the down years. So it's really simple. I mean, it really annoys me on TikTok. Yeah, but you can't meet it. Yes, you can. There you go. Done. Move on. So we create client portfolios. Now, when we create a client portfolio, the client portfolios will differ based on the drawdown a client can take. So Paul could take less drawdown than, actually, to be honest, I don't think anybody could take the kind of drawdowns Dinshaw can. But so he gets the bigger rewards because he's willing to take more volatility of movements in individual stocks. Whereas Paul would say, I don't want more volatility. And we might say, well, Paul, you're not going to sell them even if the volatility. No. I just don't want the bumpy ride. It scares me out. I should look at my portfolio and see that stock might have dropped 50%. So can you make sure that the stocks are lower volatility? Okay, fine, but you're going to get a lower return. And those are the ones. Okay, and how they have done. There's no guarantee they'll continue doing how they've done in the past at all. There's just no guarantee at all. And you would rebalance them annually, and it's a very simple activity. Okay, I've explained before the problems we try and solve with these rubbish fund managers so that you manage your own capital. Now, brokers like Interactive Brokers, Interactive Investors, Free Trade, they're all very good. Simple. You've got a brokerage, SIP, ISA, 401k, tax-free, sorted. Go through. And then we end it with that. There is a danger I oversimplify it, but that's it in simple terms. Okay, and yes, we want croaky cash return on capital invested because Goldman Sachs data, everything is data driven. You know how to open SIP accounts or whichever accounts you want. You can join the program if you wish as well. Okay, I want to answer some questions from people, any questions people might have. Paresh, Nippon portfolio is based, right, Jacques. Oops, no, here we go. What was the quality 5? Why was the quality 5 so low? Isn't that your main portfolio? No, it's not the main portfolio, Jacques. It's not the main portfolio. Why was it so low? Some years things are up, some years things are down. The main portfolio is all of them. What we started doing, because people started thinking that, oh, if you mention one company, that must be your favorite, like a favorite child, is we started feeding every single one of the model client portfolios to members of the extended family. So there's an uncle with the AI picks. Where's it gone? With the AI picks. Where's it gone? Oh, there it is, with that one. Okay, so he got that. Quality 5 plus got that. Okay. Those with the 2 times leverage on the S&P 500 got that. Those with a mixture of this and a bit of this got a mixture of that. The quality 5 ones got that, and so on and so forth. And the idea being there is no favorite. In hindsight, of course, what was the best one? It was this. And from our filtered January further filtered list, so each month we create a list and you'd hold it for 12 months. Paresh has got the calculation. But actually, if you did it February to February, it'd be different. If you did it March to March, it'd be different. If you did it April to April, it'd be different. January is just an arbitrary date. New crypto tax reporting rules to HMRC from January 1st curb interest in crypto. Do you agree it's now a bubble? I don't know. I don't care. I have very little crypto and I'm holding it for the long term, so I really don't care. Nippon portfolio is based on risk management, not sector diversification. Jack, why? Arun, do you take into account the weight of your portfolio to different sectors? Thinking about concentration. The data and the mathematics and the statistics shows that you want relatively uncorrelated assets. That's what you meant to ask, not concentration in sectors, because if you don't realize that sectors are actually highly correlated to each other. Look at this. That's the technology sector, and that's communication services. So I have Google and I have Microsoft, and you might say, well, wait a minute, they're technology companies. You're correlated. So looking at labels is going to fool you into thinking that 2 tech companies are in different sectors. Are they? Are they not? I don't know. You might say, wait a minute, consumer electronics is Apple. Is it? Isn't it tech? No, apparently not. You might think Microsoft is in the same sector as NVIDIA. Oh, apparently not. So no, what we don't look at which sector they're in, we look at cross correlations. So we look to make sure they're not highly correlated to each other when the market falls. Now, those are things you didn't know. You didn't know it's the correlation when the market falls that's important. When the market rises, nobody cares about correlation. You want it to be highly concentrated. That's how you make money. It's why Warren Buffett has 30% of his portfolio in Apple. You want concentration. But you've been taught the exact wrong thing by retail fund managers and journalists. You've been taught that different sectors must mean that they're differently correlated. No, they're not. That doesn't tell you correlation. Different labels. There's one thing that tells you correlation. The correlation number. And the correlation number is only important on a falling market. It's not important on a rising market. The markets are going up. What do you care? When the market falls, correlation increases. You know what happened when the markets fell in 2022? Everything fell. So where were your sectors then? How come discount store Costco fell at the same time as Microsoft then? Different sectors. Where's my diversification, Alpesh? Chinese stocks fell and American stocks fell. So fund managers will lie to you that their job is to find the different sectors and diversify you. What they won't tell you, because they don't understand it, is that actually correlations to the downside are highly, they move in tandem, in lockstep. And China, in an interconnected world, moves in lockstep with America on the downside. When there's panic, everybody gets out of the market and sells everything simultaneously. It's obvious when I explain it, and the numbers show it, and the academic literature proves it. But your average retail fund manager, seriously, they wouldn't understand anything that I've just said. What have we got? Jacques, portfolios are created on persona or using, oh, right, sorry. Then why not present it? Isn't the 45 plus based on Git? It's not very clear. Yeah, it's there. Just showed you. It's right there. It's in front of you. Why can't you see it? There it is. These are all based on Git. They're all based on the Great Investments Program. They're all portfolios based on that, based on different drawdowns. There you go. It's in front of you. What more do you want? So right now, have your glasses on. Won't let you buy stocks. It has to be fun. Stuart, yeah, I'm afraid workplace, depends which workplace you're on. Thoughts on PayPal? It's still struggling, isn't it? I mean, there's a lesson in humility. PayPal, what a great brand name. Bit like Adobe and Intel. Great brand names that Americans have got. Yeah, because this table isn't everything. There's, we can show you higher numbers if you wish, Jacques, but this table isn't everything. This is a selection of the portfolios of some of the clients. You have got ones which were down. Let's see, Jacques. Look, let's see how low. Let's look at the. I want you to look at the bad stuff. Look at that, down 38%, Jacques. How rubbish is that? Down 13%, down 41%. Okay. So there you go. The January list isn't on this. I'll add it in the next presentation because, like I said, it's not on the website yet. We haven't updated it yet. It's what, January 6th. Paresh, we've got to update the website. Going to get the web guys onto putting the 58% up there from the January approved list. So each year, what we do is we put the stocks from the approved list and how they did from January to January. We could have done February to February, but we do January to January. And we haven't updated it with the 58% yet, I'm afraid. We'll update this for you, Jacques, and we'll add the 58% next time. It's a good idea because it's such a great number. Paresh, we've got to stop being so self-effacing and start putting it up there. We'll add it, Jack. It'll look even better then. Fantastic. Thoughts on sterling? I'm easy with it. I don't mind sterling. What kind of ETF can you suggest for silver and gold? Thanks. The commodities ones. I've not looked at the commodities ETFs. I mean, there are specific gold ones, but the commodities ones. Paresh, will you please make a note? We update the website and add the 58% onto it. And for me to update this and add the 58% column and the previous years, because I've not got it on here because they're on the website. But it's good. Shaq, thank you. You're going to make us look even better. And we already do. In worse, by the way, nobody's asked what was the worst performer of last year. I don't know. I've not looked. Nobody's asked that. I know there were some things which were down. I'll have to look that up, actually. I want to mention some of the worst performers. And the reason I want to mention the worst performers is because people think that everything goes up all the time. It doesn't. We have, I mean, look at that. 2022, we couldn't create a positive return. It was cash. Got nothing. Okay, 2022. And if you had the 2 times leverage, which you wouldn't hold all the way through because you'd exit on the daddy bear, but if you did, you get, when we've put what would happen if you held it, so we've put worse than what actually happened. We'd rather tell you the absolute worst of what happened than what actually happened. So the worst was minus 38. Because in one sense, I want to scare people away and think, oh God, investing isn't just going up in a straight line. There are a lot of down periods. Okay? And that's important to know that there are down periods. Is the growth value rating a multi-factor model? Yes, it is. It's based on valuation, revenue growth, dividend yields, and a few other little factors. And the weightings are based upon the literature of Eugene Famer, Daniel Kahneman, Richard Thaler, plus a few others. If you look at investing-champions.com, you'll find it there. Where would you focus on allocation today? Top 3 stocks? I wouldn't have top 3 stocks. I'll have top 3 stocks the day I have a crystal ball. Okay, for a simple reason. That I just told you during the course of this webinar, I had no idea Google was going to go up more than Microsoft, or that my my Goldman Sachs was going to go up more than Nvidia. So on that basis, I give you top 3 stocks last year. Let's pretend it's January 2025. And I say to you, my top 3 picks are Microsoft, Nvidia, and JP Morgan. Okay. And you say to me, oh, wonderful. And then we come back a year later, you go, you idiot, Alpesh. You should have said Alphabet, Goldman Sachs. No, even better. We go back to January 2025, and I say to you, my top 3 picks are Amazon, Apple, and Microsoft. And you're up about 8%. And that could have happened. I could reasonably have said that. Let's assume I did. Let's assume I said to you, my top 3 picks of January 2025 are Amazon, Apple, and Microsoft. And look at how poorly they've done. Let's assume I said that. Now, do you see why I don't say top 3 stocks? Because that's what would have happened. And I owned them during that period. I'm not trying to tell you I've got a crystal ball or a time machine. I'm trying to tell you I don't have a crystal ball or a time machine. I'm trying to tell you you have a portfolio. You don't try and gamble on which stock in that portfolio is going to do the best. Because that's gambling. You can do that if you wish. I mean, retail clients love it. They won't listen. They do it. They turn the stock market into Ladbrokes. It's what they do. And that's why people like Nick Train make lots of money. Chetan, which of the Mag 7 do you think is the most undervalued? Well, that's just a data question. It's not what I think, for God's sake. It's price to forecast earnings. I don't create the, we don't have the manpower to go through and reverse engineer their spreadsheets and their earnings models and say, well, we think their accountants are wrong and we think their earnings. But there you go, there it is. So which are the most undervalued? The lower the number, the more undervalued it is. But that's not what moves stock prices. Because I can show you the 2025 version of this, and there isn't a correlation direct between the valuation and the stock price. Very simple. It's maths. It's maths. Okay, so Chetan, doesn't matter. I capitalized with Alphabet and Nvidia last year and saw great returns when you said they were undervalued. Yeah, okay. But that's not the only factor. It's a major factor, but it's not the only factor. Think portfolios, which are undervalued there. But I'm not going to pick one of them, all 3 of them. So Chetan, I'm not going to pick one of them. And my friend, where's he gone? The other one. I'm not going to pick one of them. Because I might be wrong. But because let me put it this way. If I was willing to do that, why haven't I done it? If I was willing to say these are my top 3 picks, why don't I just have those and nothing else? So it must be the case that I don't have enough conviction in them or enough knowledge, or rather I have so much knowledge, I know you never do that. Okay? And if I did pick 3 and they did turn out to be incredible, then trust me, I'm telling you now, it would have been luck. It's the portfolio. It's the portfolio. It's why for 25 years, every single book I've written, it says you have 15 to 40 stocks. I never said you have one. And yeah, I mean, it does. But PEG ratios, have you tested the correlation between PEG ratios and future price stock movements? Have you tested that hypothesis? It's one factor. We've already incorporated in our value growth income. And the factor has a lower weighting than you might think. Because revenue growth has a bigger factor. You go, Paresh. Yeah, you got an early start tomorrow. Okay. Where would you focus on allocation today? No, we've answered that. Who else have we got? Jacques, we've answered. The Great Investment Program creates model portfolios suitable for each individual client. So when you look at this, at the start of the year, we can say, here's a portfolio, but it doesn't mean it's suitable for you because it might be more volatile. And that's the one portfolio whose returns we put on the website. And then individual models for each individual might vary because somebody might join in January or July or whatever. You know, every person's unique. So I wouldn't want to put my aunt in a digital model because she might panic one day and go, oh my God, it's dropped more. Anything else? No, I think we've done them all. Anything else, you can just email me. Nipper, what are your views about pharma and biotech? I think I've answered that. Diversification doesn't come from sector names. It comes from lack of correlation between the individual securities. If you do not do that, and here's the correlation numbers, if you do not look for interstock correlation, but you look for it through the sector name, you've got a problem. And the problem you've got is you're doing it wrong because the numbers won't support you. Okay, there's the correlation numbers, there's the sector names. And a simple bit of mathematics, as well as a bit of academic literature, will show you that correlation matters more than what the sector is called. And the hypotheses are being tested anyway, in any event, by people. Okay, guys, I'm going to go. How do I go about picking, say, 15 stocks based on the research? So it's a good question because we've been asked that before. What we first of all do, see that little button there that clients have access to called Jan Filtered? That shows all the stocks out of 10,000, which are all green in those lines, okay? Those first 5 columns are all green. And then after that, that's as far as we can go, and we'll get to about 200 stocks. If we could get to one stock, I'd tell you one stock. We'll get to top 3, we'd tell you 3. But it comes to about 200 who get squeezed out. Beyond that, we can't, we don't have another hypothesis which would give us even fewer stocks and be accurate. So any of those 200, quite frankly, you would pick. And what I tell clients is the best way to do it is to pick, based on your risk appetite, the ones with the lowest volatility, if you're least, and the ones with the high Sortino, once you've got those 200. Okay, so, and then we'll run the numbers, create a model portfolio, and make sure that historically they've done as well as we think, looking at today's numbers, they should do in the future. And if those things also rack up, then we know that the individual stocks weren't highly correlated in down periods like 2022. We always run it through 2022, and we can see, oh, okay, that's fine. We've also actually created a whole bunch of tools for free for people to sort of do this manually if they were. I think we have. There you go, portfolio stress test. Yeah, I thought we had. And you can put the stress test and it'll show you what would have happened in different periods, okay? And if you're lucky or unlucky and so on, based on the volatility, and that's the key thing. It's volatility is the main thing, okay? Because that's what we are really talking about, okay, with anything. And as you move that and then you see that and you run the stress test, you get an idea of, oh, what might happen. I'll just teach you a bit of mathematics, which is really incredibly important. It's very simple. If you take a coin, and it's 50-50, obviously, and you flip it 10 times, and it came up heads every time, does that mean it's a winning coin? No. Okay? If you flip it an infinite number of times, 50% heads, 50% tails. So what we're running with those simulations is to see what's the worst case and the best case that could happen. Obviously, the best case is all heads, but it's hardly ever going to happen. And the worst case is all tails, but it's equally hardly ever going to happen. So what we're doing with portfolios and the volatility of their historic price movements, which takes the assumption that those historic price movements would repeat themselves, okay? And most stock prices move along what's called a log normal distribution curve. But the size of that curve depends upon the volatility of the security. So Tesla's is quite wide because it's got a wide range, whereas Microsoft's is relatively narrow by comparison, whereas Nvidia's is both wide and really high than Microsoft, okay? So the point is, if within those ranges, those coin flips, what could happen in a worst case? Best case, we don't care, because the best case always looks too good. It looks great, looks fantastic, everybody's rich. But the worst case, and then when you run those, and that's still no guarantee of the future, because tomorrow there could be a nuclear bomb, we all die. There's no guarantee of the future. When we run those, we then get a better idea of, okay, how do they correlate with each other in a down market? Not, oh, they're in different sectors, different geographies, that must be diversified. Bullshit. Okay, so when you run the mathematics of it, and this is how professional investors do it, and professional hedge fund managers, it's not how retail fund managers do it. They just don't have the IQ points to be able to do it. Okay, and you can tell them that all day long, because I have in the various books I've written. So what happened, Eugene Faber, the Nobel Prize winner, has as well. So he's on my side, and so is Warren Buffett, because he said the same. IQ above 122, totally wasted in finance, rented out the rest of it. So what happened, and I know it sounds arrogant, but I'm being arrogant against retail fund managers getting £16 million for losing you 25% over a few years. So then what happens is that gives you a fairly good idea, but not a guarantee of how those coins are flipping, okay? And can you take it? Can you take the house price movements, as it were? Okay, that gives us a far good night's sleep than anything else. Okay, everything else, feel free to email me. Thank you, Chetan. I really appreciate it. I really appreciate it indeed. Tom, thank you. I hope I wasn't curtain short. It's been one hell of a day today. Not because of the markets, I should say, just other things. We've got multiple members of the family in hospital simultaneously. So anyway, thank you all. I better go. And Stuart's up at 4 a.m. I'm actually an office cleaner with ISAs and cash savings, semi-retired. Stuart, email me if I can help you in any way. We've got a ton of free resources. So good luck to you. Summer job for me when I was training initially to be a barrister. I used to clean nightclubs. Okay, many thanks, all of you. Thank you all, everyone. Appreciate any questions. You can still email me. Okay, guys. And anybody who wants to join the program, you know where to go. Go to campaignforamillion.com. You can join the program. You know what we do, but I try and impart in these webinars a stock market update so that you can learn. Because I know the program's for 1% of people. Just in the same way, you know, I don't know, Mercedes or Porsches are for 1%, but the 99% should, that's our principle, it's why I wrote the books and the newspaper columns, should have access to knowledge and so on, and know what mistakes not to make at least. Okay, so I hope you get your SIPs and ISAs and learn to do it yourself more and more. The more you do yourself, the better I think you'll be. And don't give your money to Nick Train, God forbid. Having said that, he'll probably throw 3 heads in a row by good luck in the next year. Can't keep losing and throwing tails, can. Okay, guys, I am